is raised by companies and governments in the form of shares and bonds. In contrast, the money markets can be thought of as the market for shorter-term bonds. This is where companies and governments can meet their short-term borrowing needs. Money market instruments have a much shorter period of time between issue and maturity when compared to bonds, often just 3 months or less, but not exceeding a year. What are the main types of money market instruments? In the UK, there are 3 main types. The first type is known as a Treasury bill. They are normally issued weekly on behalf of the UK government. Treasury bills do not pay interest to the holder like a standard bond. Instead, investors pay less than the par value for them. This is known as being issued at a discount to par. Let's look at an example to see how this works. An investor pays £990 for a Treasury bill with a par value of £1,000, which has a maturity date of 3 months later. At the maturity date, the par value of the Treasury bill is paid back to the investor by the government. The investor's return is the £10 difference between what was initially paid by the investor and the amount received by the Treasury bill at maturity. The second type of money market instrument to know about is a certificate of deposit, or CDs for short. Put simply, they are tradable bank deposit accounts. They are issued by banks in return for deposited money and can be bought and sold in a similar way to shares. Let's take an example. Lloyds Banking Group might issue a CD to represent a deposit of £1 million from a customer, which is redeemable in 6 months. The customer will receive the £1 million back from the bank after 6 months, as well as an agreed amount of interest. If the customer needed their money back before the 6 months is up, they can sell the CD to another investor in the money market. The third type of instrument is a commercial paper, also known as CP. CPs are issued by large companies and do not pay interest in a similar way to Treasury bills. Companies and banks normally agree a program of issuing CPs well in advance. It's normally agreed that a particular value of CPs will be issued, and within that amount, the company will issue CPs with different maturity dates. Why are they attractive to investors? It often requires large sums of money to invest in money market instruments directly. Therefore, it tends to be institutional investors such as pension funds and insurance companies who buy them. Money market instruments are a relatively low-risk way to generate a return as the par value is preserved in the same way as bonds. This makes them popular during times of market uncertainty. As they are a short-term and less risky investment, the level of return for an investor tends to be once tax and inflation have been taken into account. Returns might only just be positive. Keywords: capital markets, money markets, Treasury bill, certificate of deposit, commercial paper.